We're going to talk about in-kind donations. Now, an in-kind donation is essentially a donation where you donate the good or the item as it is in kind, an actual something that you give, as opposed to a dollar amount. But fundamentally, inside of an in-kind donation, there's two different types of assets. There's a tangible asset, and then there's an appreciated asset. Throughout this lesson, we're going to talk about both of those types, and I'm going to share with you two small stories or short stories that illustrate both of those through an apple farmer and an apple investor. You know that I love my stories and I love to illustrate and make it simple. So here we go. The first one is the story about an apple farmer. Now, after a farmer had sold as much of his harvest as he could, he drove to the local food coalition and donated his remaining 10 bushels of unsold apples. Each bushel weighed 100 pounds, and he multiplied the total pounds of apples he donated by the current cost of a pound of apples at the local grocer. This totaled $1,000 and it qualified as an itemized deduction. So let's kind of back up and simplify this a little bit. As you can see at the bottom of this chart, he had 10 bushels of apples. Each bushel weighed 100 pounds. So he had 1,000 pounds of apples that he donated to the food coalition. On the other side of the chart, you see that the market value per pound was $1. This is very simple math. $1 times 1,000 pounds is $1,000. The current value of his apples was $1,000. So as this farmer donated it to the food coalition, he was able to write off $1,000 as an itemized deduction on his tax returns. This is a great example of an in-kind donation from a tangible good. Let's continue on to the second type of an in-kind donation, which is an appreciated asset. Here's the story about an Apple investor. Many years ago, an investor purchased 10 shares of Apple stock at $10 per share. I know, wouldn't that be so great? With a total value of $100 of Apple stock. These shares are now valued at $100 per share. If the investor were to sell these 10 shares, he would pay a long-term capital gains tax on the $90 per share of growth. If the investor were to then donate the 10 shares, he would get an itemized deduction of $1,000 and permanently avoid paying the long-term capital gains tax on the growth. So again, let's kind of simplify what's happening here. For this Apple investor, many years ago, he bought 10 shares at $10 per share, so he owned $100 worth of Apple stock. Now today, those same shares are worth a total value of $1,000. So this Apple investor essentially has two options if he wants to sell and donate those funds to charity. He could sell them outright and then donate the remaining portion. However, he's going to have to pay his 15% or more capital gains tax or long-term capital gains tax. As you can see in this chart, that first option is sell and donate. He would pay $135 of taxes, and then he would be able to keep or donate the remaining $865. So if he were to just do the traditional way, sell those shares and donate the remaining amount to charity, the IRS gets involved and takes some taxes. However, if this Apple investor were to use an in-kind donation, he can take those same 10 shares of appreciated Apple stock and donate them directly to a qualified charity, essentially kicking the IRS out of that transaction and paying no tax in the meantime. So that full $1,000 of current value of his stocks would be able to be contributed directly to charity. There's many kinds of appreciated assets. Some of those here are appreciated stock, just like Apple, or bonds, or gold, or precious metals. You can also donate real estate as an appreciated asset, or appreciated artwork, or anything that has an appraised value. Now that we've covered the two types of in-kind donations, let's dig into the benefits a little bit. As you can see from both the Apple farmer and the Apple investor, there's a double tax benefit that's going on here. You're permanently avoided long-term capital gains tax, and then you're able to deduct the current value, even though the original cost of these items were much less. Now, to qualify for that, there's a few requirements. The first thing is you have to have held those assets, those appreciated assets, for longer than a year to qualify for that long-term capital gains benefit, as well as the actual goods must be able to be appraised and documented. Last but not least, this is not available inside a qualified retirement account like an IRA or a 401k. These funds need to be after-tax funds, like in a brokerage account. Now, after all this, you might be asking, okay, when is it a good fit, Devin? If you're planning on a one-time contribution or regular contributions to one or more charities, an in-kind distribution might be a good fit for you. If you have a non-qualified account with appreciated assets or physical goods with an appraised value, it might be a good fit for you. And then lastly, if your itemized deductions are above the standard deduction amount, this might be a good fit. I want to take a minute to highlight this aspect of this in-kind donation, which is when we take this itemized deduction, you need to be able to have your deductions on your tax form be itemized. All of your itemized deductions need to add up to be greater than what your standard deduction would be. If all of your itemized deductions add up and they're still less than the standard deduction, an in-kind donation doesn't have as much net benefit for you.